Just days ago, 94-year-old Warren Buffett sat on the stage at Berkshire Hathaway's 2025 shareholder meeting and uttered words that sent shockwaves through global financial markets. This statement has been interpreted by outsiders as his death sentence for the US dollar. Behind Buffett's warning, an epic crisis in US stocks is brewing. Today, we will uncover the truth of this crisis, and more importantly, how ordinary people can protect themselves. Hi everyone, I'm Lily, the rebel queen who loves playing with US stock. In today's video, I want to take a deep dive into the hidden risks in the current US stock market. There are many stock market legends, but Buffett may be the most undisputed one. Since buying his first stock at age 11, he has embarked on a legendary investment journey, and his investment theories have been revered by countless followers. So why is this financial titan, who once declared the US dollar is the world's safest currency and whose Berkshire Hathaway holds a record $347 billion in cash, now publicly bearish on the dollar? Let's take a look at the key market data from recent times. In the past month, the US dollar index has dropped by 5%, reaching a 3-year low. Meanwhile, gold prices have soared to $3,400, with a surreal scene emerging in the Shuaibei market in Shenzhen, China, where citizens are seen rushing to buy gold while dragging their suitcases, and the price of gold has surpassed 780 renminbi per gram. Why is the gold market so crazy? One of the main reasons is that global central banks are massively selling off US Treasury bonds. China reduced its holdings by $23.5 billion in March, Japan sold $18 billion, and even Saudi Arabia is quietly shifting its assets. Buffett put it bluntly, the US federal debt has surpassed $36 trillion, and the daily interest alone consumes $27 billion. This is a Ponzi scheme. In international markets, gold has always been priced in dollars. Its surge this year doesn't mean gold itself is more valuable, it means the dollar is losing value. The dollar index has been in freefall since Trump took office, down 9% cumulatively. Some might argue this is a strategic devaluation to ease debt pressure and reduce trade deficits. But let me be clear, a weaker dollar is not a good thing. While it may boost export competitiveness and reduce debt burdens nominally, it also fuels domestic inflation. The debt relief is merely a drop in the bucket. Currency devaluation is a stopgap that erodes dollar credibility, threatening the century-old dollar hegemony. If faith in the dollar collapses, the US will be dethroned as a superpower, demoted to a regional player, and lose its ability to export inflation via dollar supremacy. For a nation whose manufacturing muscles have atrophied over 80 years, self-reliance would be agony. Can an America great again dream really be sustained by the current AI bubble in US stocks? Some might interject, AI isn't a bubble, it's core technology shaping our future. But the AI bubble label isn't my invention, it came from US Treasury Secretary Bassett. In a recent interview, he admitted this market downturn began when China's DeepSeek AI launched, not due to Trump's policies, calling it a reality check for US AI. While seemingly defending Trump, this exposed the market's speculative excesses. The Magnificent Seven tech giants have plunged 15% this year, dragging the S&P 500 down 5%, while the index's other 493 stocks held steady. The problem clearly lies with these AI-heavy tech titans. Classic bubble signals are flashing. The S&P 500's PE ratio has exceeded 30 times, a 20-year high, even as the index fell 3% this year, a divergence eerily reminiscent of the 1999 dot-com bubble, PE 32x, which preceded a 43% 3-year crash. 2 decades ago, Buffett warned of a profligate town, the US, and a thrifty town, China, cautioning that endless debt would sacrifice future generations' economic sovereignty. Today soaring US debt and tech valuations are the same Ponzi dynamic, using new debt to service old. No wonder Buffett broke his usual restraint at his final meeting, likening it to a pyramid scheme. Yet many still cling to blind faith in US debt, insisting default is unthinkable. But ask yourself, isn't this the same denial seen in Ponzi victims? You're now rooting for more greater fools to join the scheme to protect your own stake. Okay, let's assume that US Treasury bonds won't collapse, that they can pay back principal and interest without default, and that the $100 you invested in US Treasury bonds eventually gives you $150 back, which makes you happy because you've earned $50. However, when you go to the supermarket, you realize that the TV that used to cost $100 now can't even be bought for $150, and the price of eggs has gone from $5 a box to $10 a box. Holding your $150, you find that you've made a hollow profit. To those friends who are still optimistic about U.S. Treasury bonds, you need to think carefully. Is your investment aimed at achieving a fixed numerical increase or the growth of actual value? Moreover, if U.S. Treasury bonds really carried no risk, why are central banks around the world significantly reducing their holdings of U.S. Treasury bonds while continuously buying gold? Some say it's because China and the U.S. are at odds and that China wants to diminish the influence of the dollar. But let me ask you, Japan, as one of the U.S.'s closest allies and the largest foreign holder of U.S. Treasury bonds, why did it reduce its holdings by $55.5 billion throughout 2024 and another $27.3 billion in March of this year? Countries like the UK, France, India, and Canada are also continually reducing their holdings of U.S. Treasury bonds. Whether they are adversaries, allies, or even close partners, they are all reducing their U.S. Treasury bond holdings. Claiming that U.S. Treasury bonds are problem-free is simply false. So how can ordinary people hedge these risks? Buffett's moves offer clues. 1. Inflation hedge. 80% of Berkshire's cash sits in short-term treasuries yielding 4%, outpacing the dollar's 2 to 3% annual erosion. 2. Dry powder. Holding liquidity lets you pounce on distressed assets, a strategy Buffett used with cigarette-butt stocks and now deploys in Japan. 3. Geographic diversification. His heavy bets on Japanese trading houses, earning steady dividends, suggest looking beyond overheated U.S. markets, whether to gold, crypto, or undervalued equities like China's. In this era of uncertainty, Buffett's lesson is clear. Stability is the new alpha. That's all for today. If you found this helpful, smash like, comment, and subscribe. I'm Lily, see you next time.